Hello, my name is Shreyans, and today we are going to talk about a company who's been able to create one of the most successful consumer brands in the country, especially in a space that is slightly more difficult than others. So we'll talk about it, but before we start, please remember this is not investment advice. We're just trying to understand about the financial performance and position of the company. The company that I'm talking about is something that is a household name actually, Titan, right? As you might know, Titan serves in the markets of jewelry, watches, and eyewear, which are slightly more difficult, right? Because if you look at the watches market, there are a lot of local players, right? And there's a lot of fake watches also going around, right? And within the jewelry market as well, most of the jewelry market works on the basis of traditional setups, right? We have a traditional jeweler stores and everything operating like that. Most of Titan's revenue comes from the jewelry segment, which is its brand Tanishq, right? But its market share is more dominant in the watches segment. And because we also have heard more about Titan's watches than, linking the Tanishq brand with the Titan company. But anyhow, Titan owns both of them, and it also has other brands like Fast Track, through which it also sells eyewear. Okay, let's start with the financials of the company. And the thing to understand here is that they've been slightly consistent in between. In fact, all the three, revenue, EBIT, and PAT. So if you look at this 3-year period here from FY14 to FY16, there was slightly muted growth or degrowth. In fact, in these 3 years, right, 2 good years here, then slightly muted 3 years here, again 3 good years here, right, and then again a slightly slightly inconsistent here. And I don't know how good FY21 would be because of the lockdown. Its sales would have been severely impacted, and also because now people have comparatively lower disposable income, and the kind of segment that Titan serves, it will be interesting to see if it is able to generate decent enough sales for FY21, although it seems slightly difficult, right? On an overall basis, although it has been decent, revenue is up 3.2 times, so the revenue CAGR is around 14%, and EBIT and PAT CAGR are slightly better, so 15.5 for EBIT and 14.8 for PAT. So in the years that it has done well, it has done quite well, but there have been few years that have put a break to those years, right? Okay, now moving on to the cash flow from operations. So now this is where it gets slightly tricky, especially from the high level, is that the cash flow from operations is not just inconsistent, but if you look at it, then cash flow from operating activities is around 4,800 crores versus a total PAT of 8,700 crores. Like, this is something that is slightly more difficult to understand. When I went into the breakdown of cash flow from operating activities, I figured that there were a lot of working capital related outflows, right? And which is why the cash flow from operations figure had been lower or had been even negative in few years. And this is something that's understandable because for a company like Titan, its inventory would be not just one of the largest assets, but it would be the most valuable assets as well. It has high value inventory, not low value inventory, so to speak. So that is understandable, but I mean, it seems slightly difficult to really understand fully that what's really happening here. A lot is going into the working capital, but probably if you go deeper, we can compare, before the operating profit before working capital changes to the PAT, and then figure if it's cash, how good is its cash conversion, right? With cash flow from investing, the company has continuously reinvested into its fixed assets, not a whole lot of amount, but yeah, probably opening up new stores or doing that sort of thing. So it has been small reinvestments, few transactions here and there regarding financial investments, but that's okay. Most of this actually relates to purchase of fixed assets, right? Cash flow from financing, if you look at it, so most of these outflows actually relate to dividends, or some of the outflows relate to the other financing items, maybe small financial costs here and there or other things, right? But there have been constant dividend payments. There has not been a lot of borrowings, to be honest. There have been some borrowing transactions, but most of the company's borrowings are actually short-term borrowings, right? And the long-term borrowings are mostly insignificant, which is something that we'll see when we come to the balance sheet part. So equity is up 6.4x. Now this is a staggering number. So if you look at the book value of equity, it has gone up by a CAGR with a CAGR of 23%. So I mean this is very, this looks very good, right? And if you look at the current assets and current liabilities positions, the growth in current assets has broadly been in line with revenue. So current assets are up 3x and revenue is up 3.2x, right? So broadly in line with that. Current liabilities, the trend here, the increase here is slightly lower than that in the current assets. So obviously the working capital base expands, and the growth in working capital is greater than the growth in revenue, right? A lot of current liabilities are actually borrowings in addition to trade payables and the other normal stuff, right? Looking at the non-current assets have gone up by 7.6x. So, right, what you could see here is that the company was operating from a very relatively very small base up till here, and probably one major expansion here, and then again it has gone through some sort of expansion here in FY20, right? But still, the asset base is more or less small, and I think that is something that we can reasonably expect. Non-current liabilities have mostly been insignificant. There was a slight, not a slight, but there was a sudden increase here and another increase here. So FY16 is something that we'll have to check, but in FY20 these are not borrowings. I went to the balance sheet because I wasn't able to figure this out, and I found out that most of these are related to lease liabilities. So it is quite possible that the expansion that the company has done here has been funded by lease liabilities. So probably it has opened up new stores or something like that, for which it has taken financial leases, and that is why it is being classified here. All right. Now let's quickly go over the growth of the high level financials. So as you talked about revenue, EBIT and PAT, first good, then slightly poorer here, then again good, and then again slightly poorer here. And it will be interesting to see how FY21 goes, although it's difficult for the company to, to have a good growth, so to speak. It might even be at a risk of degrowth. Cash flow from operations quite inconsistent, to be honest, and it seems that the company is investing more and more into working capital, primarily I think inventory, right? Very solid in equity, as that is understandable, right? Assets have also kept on increasing. The company has gone through a couple of expansions in these phases. The growth in net working capital has been greater than the growth in revenue, because sort of similar growth in current assets, but constrained growth in current liabilities. So company is able to control that, right? Liabilities have more or less been not so significant, especially the non-current liabilities, and the current liabilities are very well covered by the current assets, right? Okay, now let's look at the metrics. So if you look at the return on capital and return on equity, these have been very good, right? Especially in these 5 years, these were very solid numbers. However, in this year here and going forward, it has again started improving. But in these 5 years, if you look them, these are below the median. So right, in these 5 years, it has been the both return on capital and return on equity are actually below median. And in the initial 5 years, although there were a couple of years here where there was not a lot of growth, but still the company was able to generate very solid returns on capital, right? And although the trend has again started moving upwards, but it seems to have stabilized in these 3 years. And let's see how it goes in the upcoming years, right? Now let's break this down, the return on capital, into margins and asset utilization. So if you look at the margins have broadly been maintained, right? The EBIT margin and PAT margin, if you look at here, they've slightly improved, but I mean, the minimum is 7.2 and 10.1, and here the minimum is 5.4 and maximum is 7.2. So they've more or less operated in a very similar sort of range, right? So this is something that is to understand here, because the company is not really able to improve its margins. And this came as a slight surprise to me, because the company kind of operates in the higher end of the consumer class, because its watches are also towards that price range, and jewelry is also towards that sort of price range, right? But still the company doesn't have very solid margins, as something that you might expect from a luxury brand or a high end brand. So lower margins but very strong asset utilization. So if you look at, as we were talking about as well, so it has a very low capital base, right? And that capital base gets utilized very well, right? And in fact, a lot of, although this asset turnover ratio seems below 2, all of these, but no, fixed assets are very far and few. most of the assets are actually tied up. A lot of the assets are actually tied up in inventory. And if you look here, then probably in the 5 years, again, this sort of seems to have been going around in this range. The capital utilization, it is fallen from the very amazing figures that were there in FY11 and 12, but that's understandable because as the company is expanding, the capital base is also expanding, right? But yeah, I mean, this seems very good still, to be honest, right? The company is able to generate good capital turnovers, and this is the major driver behind the return on capital because the margins have been on the lower end and the margins have not, expanded. Talking about the leverage position, the company has had comfortable leverage position, to be honest, right? Because most of its liabilities are actually current liabilities, and the non-current liabilities have been very insignificant. So this is also sort of contributed towards the return on equity, good return on equity as well. But comfortable overall, comfortable leverage position, right? So CFO to PAT, we've talked about CFO has been quite inconsistent to be honest, right? And because the reason I found to be investments in working capital, right? Net cash flows, is this something that we talk about? It's a negative of 139, right? So the company has been reinvesting as well, although the reinvestment needs are not very huge, right? And then it has also been paying out dividends consistently, right? The dividend amount has been again moving around in a range, but yes, the dividends have been consistently paid out by the company, right? Working capital is something that we've talked about, right? Trend in current assets along in line with the trend in revenue. Current liability is well controlled, right? And that is why you see that the working capital increase is quite more than the revenue growth. Non-current liabilities to equity, very insignificant. Even with the sudden increase through lease liabilities in the current year, the figure is still very, very controllable. The figure is still, it doesn't seem to be very high, right? It's very much in control. All right. So now let's quickly wrap up with the highlights of the company. So I think decent revenue, EBIT and PAT growth, decent but inconsistent, I would actually say here, right? Decent but inconsistent revenue growth. And because FY20, FY21 would be years where we need to watch out that these might be the down years for the company, right? Cumulative CFO is approximately 55% of cumulative PAT. Here you see 40 crores and 87.45 crores, somewhere around that, due to investments into working capital items, right? Continuous reinvestment into assets and dividend payments. This is something that can be seen. Equity is up 6.4x, negligible borrowings. In fact, the major item of non-current liabilities is lease liabilities, right? Or which will include lease payments as well and some bit of finance cost there. Working capital trend broadly in line with revenue. Now, most significant asset is inventory, which is very, very understandable because it has lots of inventory and most of its inventory is also high value, right? Return on capital employed greater than 25% in 8 of the last 10 years. Return on equity greater than 20% in 8 of the last 10 years again, right? Just a second, sorry. Yeah. So now these are very good figures, to be honest, for a company that hasn't had the most consistent growth. Good growth in some years and slightly muted growth in other years, but good financial performance, so to speak, in most of the years, right? EBIT and PAT margins have broadly been maintained. I think both of them are currently at their highest. But still, I mean, there has not been any sort of significant expansion, so to speak of, right? Where there has been, because in 10 years, it's been like 2 or 3 percentage points. So, I mean, that doesn't seem very significant, at least to me, right? Capital turnover has been greater than 3x in 8 out of the last 10 years. Asset turnover greater than 1.5x in 9 out of the last 10 years. So this is something that we can see that the company does have strong asset utilization and it is able to, it is able to generate a lot of revenue from its capital base multiple times. So it can go through multiple revenue cycles. Strong financial position and performance along with decent growth. So this is the sort of conclusion that I was able to make from the company. Although I think that the growth might be challenged for a couple of coming years, but let's see if the company can get back on its growth path. I mean, it is a very, very well-known consumer brand. Almost a lot of us have actually used its products, especially watches. Jewelry, I'm not so sure, but definitely we might have bought watches that are being made by Titan. So let's see how the company performs in the coming 2 years. Strong financial position, very negligible borrowings. These liabilities are there, but I think that those are very manageable. Good performance on the return on capital sides. Overall, it's the growth is decent, but it seems to be in a cyclical industry, right? So that is all that I had to share about this company. I hope you found this helpful. If you have any questions, then please drop them below and I'll get them back. I'll get to them as soon as possible. To receive this and much more straight to your inbox, you can subscribe. And the link to the WhatsApp list is also in the description, as is the link to the Excel worksheet that you can find. There is a folder which contains all the Excel sheets of all the companies that I've covered till now. So thank you so much for watching. If you found this helpful, then please share it and I'll see you again with another video.